Okay, so good morning, everyone. Welcome to this special edition of the Macro Snapshot. This is a preview of the FOMC meeting today. So today is, I'm doing this at Wednesday, March the 19th, 2025, about 9 o'clock in the morning. So let's first of all look and see what's sort of priced in by the markets for this afternoon's sort of meeting and the rest of the year, indeed. If you look here just on the Bloomberg dots function, we can see here that the green dot, all of the yellow dots represents the distribution of the 19 sort of Fed members. But we can see that the median for, let's say, at the end of 2025, it's really concentrated here around about 3.3875, which is rounded up to about 3.9. So what we can see here is that if we sort of project this out through this year, so 2025, till the end of 2025, we can see here that the median, as I say, is about 3.3875, but which is the green line. But what's interesting is that the market is still a little more sort of dovish. So the market here, you see, is the Fed funds futures latest value is the white one, which you can see projected for the end of this year is about 3.75. So a little bit below that. And we can get a better sense of that if we look at a couple of other metrics. So again, always using the Fed funds futures, we can see that by the end of the year, the market is projecting here about 2.28 cuts. So the Fed's dot plot, which we'll see in a second, is about 2 cuts. So the market is a little more dovish, expecting a totality of about 57 basis points of cutting by the end of this year. But if we actually look at just how the market has changed, again, this is pricing for December 2025, the number of cuts. And as I just mentioned, you can see that currently we're looking at about 2.2 cuts or so, but that had got down, if you go back just as recently as essentially like 9 or 10 days ago, down to about 3.5 cuts, 3.3 cuts. So pretty dovish here, based on this idea that, the US economy was, somehow going towards a recession, that Trump's policies on policy uncertainty and tariffs was probably going to cause sort of a growth scare, and therefore the Fed would be obliged, because of that, and also because of maybe sort of higher unemployment, to cut more aggressively, and so that the market priced it in. But again, if you look all the way, just after the Fed's most recent meeting on December, I think the 19th, I think it was, you can see that we're up to just 1.5 cuts. So we've been trading in this range of the Fed cutting, 1.5 to 3.5 times. So it's like a sort of a two cut sort of spread. And that's reflected, again, if you see the Fed funds curve, again, you can see what's projected to by the end of 2025 here. You can see that, the Fed's expected here to get down to about 3.785. But if we look, let's say, a week ago, you can see that it was actually a little more dovish. So you can see that a week ago, I'll just put this on the zoom here. Let's just zoom in. It's a bit easier to see. So you can see, like, let's say a week ago, that was actually even a little bit lower, as I said, at about 3.67. On the other hand, if you go, let's say, a month ago, and again, I'm just going to zoom in, which is the yellow line, you can see that a month ago, where it was a lot more hawkish, the market was pricing in up here about 3.975 as the yield, the implied yield by the end. So you can see here the market was a little bit more dovish. A month ago, it was a little bit more hawkish. And this is basically a function of just reacting to sort of news from Trump and the tariffs and the perceived economic sort of data. So the question is, what does, for example, what can we expect today? So essentially today, really what we're going to be looking at is going to be the summary of economic projections. So we're going to look at GDP, where the Fed thinks the core PCE will be, the unemployment rate, and of course where they think the dot plot will be. Not that they have a particular sort of necessity to follow the dot plot, but before we look at that, what has Powell been saying? And I just got looking back to a speech Powell made, I think on about March the 7th, and just a couple of quotes here. He said, quote, "The US economy, despite the uncertainty, the high level of uncertainty, continues to be in a good place." Now, remember, they have the mandates of full employment and price stability, but he's saying that, there is instability and a sort of a lack of certainty, but the economy continues to be in a good place. Second quote, "We don't need to be in a hurry to alter monetary policy. We don't need to be in a hurry to alter monetary policy." And third quote, Powell said, "We are well positioned to wait for greater clarity. So putting it all together, I think there's two sort of takeaways from what Powell's been communicating and other members of the Fed is that the economy is more or less okay. Inflation's a little bit sticky. There could be some concerns about higher inflation expectations. On the other hand, the unemployment rate is relatively good, and they essentially want to wait a little bit. So I think that's sort of like what Powell is aiming to do. If we look at, let's just now actually go and have a look and see what happened last time in late December. So we can see that in late December, this is the summary of economic projections, and the key numbers here, in my opinion, I've put here in the pink highlighter. So we can see that basically from September to December, the Fed actually was a little bit more hawkish. They revised the number of cuts. Actually, they reduced. So they revised upwards. They reduced the number of cuts by 50 basis points to 2 cuts. So they had been forecasting, a rate at the end of 2025 for Fed funds of 3.4. They revised that higher, so more hawkishly by less 2 cuts by 50 basis points. Now, that's the question is, will it stay that way? And as we just saw, the market is a little bit, maybe 10 or 15 basis points more dovish than that. So that this represents the current Fed funds rate is 4.33 approximately. So this is a rounded number of, I think, 3.875. So essentially, this is 2 cuts. So the Fed is projecting 2 cuts. So this is the first thing to be looking out for. The second thing is, I would say, is just what they do over 26 and 27. But probably more importantly is the longer run, which is sort of a code, so to speak, for where the Fed thinks the neutral rate could be. So that could be an interesting one to be looking at. The other key numbers here is going to be the core PCE inflation. As you can see from last September to December, they revised that upwards. So, basically saying that core inflation was a little stickier. That's going to be very important to look at that. Will they just maintain that? Or will they actually sort of say, we think that, core inflation is getting a bit stickier. Unemployment rate was actually revised downwards, indicating a stronger labor market. Again, will they give some kind of tweak to the statement, which I'll show in a second, which could indicate that there has been a few little movements here and there. And again, in terms of the overall performance of the economy, the change in real GDP, you can see here that last time they revised it upwards to a stronger economy. Now, we all know that, a lot of the sort of consensus in market over the last 2, 3, 4 weeks has been, this growth scare that Trump's policies of potential tariffs would actually reduce growth in the US and even potentially global trade. This would maybe benefit the rest of the world, especially Europe. So we know what that sort of consensus has been. So the real question here is, will the Fed want to actually sort of, move anything, and would that be too much of a political signal? Because let's now look at a couple of sort of different scenarios here, and I just want to look at, let's say, for example, before we get onto the dots, maybe look at the way, and this is coming from a Goldman Sachs kind of sort of hypothesis, which is kind of interesting to see that ways that the statement itself could be just tweaked a little bit. So if we talk about economic activity has continued to expand at, rather than a solid, they could say a moderate pace. So that would indicate potentially changing the GDP dot a little bit softer, maybe by 1/10 or so. I mean, still saying that the economy is expanding, but instead of being solid, it's moderate, so a little softer. Talking about unemployment rate, they can say it's stabilized at a low level. This is from the statement, the last statement. Labor market conditions remain solid. Okay, good. Inflation remains somewhat elevated. And then in terms of inflation, what they could possibly say is, although some survey-based measures of longer-term inflation expectations have risen, and this would be probably referring to the University of Michigan, where you remember, like on Friday, the expectations for the longer run actually spiked pretty severely up to, I think, 3.9 or so. Market-based measures of inflation compensation are little changed. So the point is here that if you look at inflation swaps, as Goldman is suggesting, they've actually not changed too much. But where we are starting to see in the surveys, it's like consumer surveys or surveys of consumers' inflation expectations, which have gone up a little bit. And we know that Powell and the Fed in general doesn't like it when, sort of regular people or consumers' inflation expectations rise. They would not want to see that because their belief, theoretically, is that people's activity actually changes in terms of inflation expectations. So they will want to sort of keep that down. So it'd be interesting in just to look at the statement to see whether there is some sort of nod, some kind of, understanding that, hey, we're looking at this. We don't actually believe that inflation is going up that much, but it, certainly consumers do, and also to signal that economic activity perhaps has expanded at a moderate rate. Um, Now, the other issue here is to look about the uncertainty. So to say the economic outlook, they could possibly say add something like uncertainty about the economic outlook has increased. So that's kind of interesting. And again, that would be sort of a nod to talk about, sort of Trump and the tariff uncertainty and everything like that. But the question here, if we then actually start looking at the summary of economic projections, personally, I think you have to look at this also politically. I mean, we have Trump supposedly on April the 2nd. I just saw a headline saying there's going to be trillions of dollars of sort of imports which are going to be tariffed. And that is possible. There is a lot of uncertainty. I think, as Powell has indicated, that his base case is probably just to do nothing. They are not going to cut interest rates today, and they will certainly not hike interest rates today. So the question is, if they lower the dots, let's look at that scenario. Let's say, for example, they lower the dots. They would only lower the dots, let's say by 25 basis points. What is that signaling? That is signaling that they may have to cut not twice in 2025, but maybe thrice or three times. Why would they need to be doing that? That is sort of signaling that they do believe that there is a potential for a recession or at least a growth slowdown. And therefore, if that is the case, if they were to lower the dots, wouldn't that mean that they were signaling some kind of recession or a slowdown? And therefore, wouldn't that mean that they would probably have to change the GDP number down, let's say back to 2, maybe the unemployment rate, put that up to 4.4, inflation, potentially that would be interesting. It would be signaling, we'll see what they had to say there. But if they were to lower the dots, let's say by 50 or 25 basis points, so this number would go, let's say, to 3.6, that would signal, not only that they believe that, possibly a growth slowdown or some kind of mini recession, but that would also signal that equities are probably a little bit too high. That would, so that would cause probably a pretty big equity sell-off if they were to lower the dot here. I think the front end, in terms of like the ZT or the SOFA Z25 or sort of June 26, would really love that, of course. That would no doubt cause, let's say, a bull steepener. In the sense that the front end the yields would come down a lot more aggressively than the long end yields, which wouldn't like it as much. And we might get, let's say, something on the 2s to the 10s yield curve. If you look at the 2s to 10s yield curve, that could bull steepen up to the next level, which is about plus 35 basis points, and maybe even up to plus 42 basis points, which is the next level there. In terms of the long end, if they were to reduce the dots here, I think the long end would be pretty unhappy about that, and we might get that steepening quite a lot, because that would indicate let's say, for example, they reduce the dots, but the core inflation number remained the same. That would indicate that in terms of their mandate, they were maybe starting to focus a little bit more about the employment mandate and sort of where the real economy was going and growth, rather than worrying about the sticky inflation. So that's that one. Okay. But again, I think there's not much benefit for the Fed to do that, because if they were to change these sort of numbers here and also lower the dots, they are sending a signal, and that could be interpreted politically, that they don't believe that best sense policies are necessarily working, and that that would sort of essentially be saying that Trump's policies are potentially going to be causing a growth slowdown. And I think at this delicate moment, the Fed, Jerome Powell, probably, we know he has breakfast once a week with Scott Bessent of the Treasury. He's obviously a very sophisticated market participant with a lot of experience, 35 years of investing. And I think that probably Powell thinks he can work with Scott Bessent and will want to work with Scott Bessent. So what is the benefit politically in antagonizing him by changing the dot before there's actually any clarity coming on the tariff policy? So I think there's very limited, the risk reward is not great for Powell to actually change much here. But that's what would happen, in my opinion, to the market if they were to lower it. Okay, so what's the base case? The base case is probably that they maintain it. What could be interesting is, so let's say they maintain everything, but let's say this longer rate, they actually push that up, and that would be signaling that the FOMC believes that the neutral rate, which is over the longer term, the sort of famous R star, actually could be a little bit higher. So growth a little bit higher, sticky inflation a little bit higher. That would be hawkish. And that would probably lead to sort of lead to a long end led sort of bear flattener, in the sense that that would indicate that would be the result of that. That would lead to that sort of flattening there. So that's something to think about there. Okay, what would happen if they were to, let's say, have higher dots? So what would higher dots mean? If they had higher dots, that would be pretty sort of hawkish. Now, remember, if they lower the dots, that would be signal. Is that going to be good for equities? In my view, that would not be good for equities if they lowered the dots, just because that would be seen possibly by the market as a sort of a precautionary lowering of the dots, and sort of like a bit of panic, basically saying, "Oh my God, the real economy is potentially going to be weakening into a mild recession. We better sort of cut more aggressively." So paradoxically, I don't think the equities would like that. On the other hand, if they were to hike the dots or put the dots higher, let's say to 4.1 or something like that, or 4.2, I think that would probably be a case of wanting to buy put spreads on the equities, so selling equities as well, because that would be indicating that maybe the economy, inflation is high, they're worried about inflation, they don't see any sort of any need to cut at all, maybe just one cut. So that would be a pretty substantial shock to the equity system there, and that would no doubt cause, let's say, sort of a bear flattening. I think in that point we'll see the front end yields go up quite a lot, and that would cause the curve to bear flatten. So I think that would be negative for equities as well, and of course that would be negative for the front end of the curve. So you'd be selling ZT, selling SOFR Z25, SOFR March 26, something like that. So I think that's my sort of view of the dots. Probably nothing's going to change, but as I say, we could look at we need to also, just to get the sense of where the Fed, if they were to change, which again I think is relatively low probability, be interesting just to see what they're thinking about inflation, and again just about the real economy here. But again, I think it's low risk reward for them to be antagonizing Trump or the Treasury at this point. So the other thing which is kind of interesting is also QT. We know that in the minutes from the last meeting, there was a mention that they may want to basically end QT early, and they could signal that they want to end the QT runoff. And then keep in mind that at this point, because of the COVID spending, massive sort of quantitative easing, so QE, the balance sheet ran up, I think it was to $8 or $9 trillion. And ever since, last year or so, the recent periods, the Fed has not been reinvesting, and so letting that run off, their holdings run off, and that's been reducing and reducing and reducing. But we've got to a point now with the potential about the debt ceiling sort of problems with Congress, that the Fed is starting to worry that they're getting down to maybe 7.5, 9, 10% of sort of liquidity in banks of the GDP, and they like to keep it at 8, 9, 10% of GDP as bank liquidity. And if they keep on sort of running off their balance sheet, that will actually start reducing the liquidity to a level with which they may not be that comfortable. So apart from all that sort of technical stuff on the plumbing, the point is that if they were, from a trading point of view, if they were to announce an end to quantitative tightening, what does that mean? Or at least maybe they could announce a sort of an end date. So maybe they're not going to end it today, but they could say, hey, we're going to sort of start winding that down. That ultimately leads to more liquidity. That means that the Fed, and we're talking about $50 to $100 billion per month of the roll-off currently, $50 to $100 billion per month of the roll-off. And the Fed has said that if they were to stop the quantitative tightening, they would buy the different maturities, the different tenors matching the sort of the market. And so that indicates that they would buy basically sort of notes and bonds all along the tenor, like the curve. And at the end of the day, that would be a positive. That would be a positive for risk. No doubt equities would love that if we get an end to QT or an announcement of the end to QT. Well, I could see equities rallying 1 or 2% on that, just as more liquidity is coming into the system. And that means essentially that the Fed is re-announcing that they are becoming a more active market participant in the note and the bond market. And we all know that, equities do love that. And ultimately, to be honest, that would probably be like a long end bull flattener as well. We could see that the yields on the long end would probably come down, would like that as the prices go up, because all things considered equal, that means that the Fed would become, as I said, a more active market participant buying the belly and the long end of the curve. So that would push down the long end yield. So it would get probably sort of some kind of a bull flattener there. And again, just to emphasize that, I think short term at least, that would be a pop of, 1.5%, maybe even 2% in the SP 500 for sure, and NASDAQ. They would like that. So that's something very important. So we have the summary of economic projections, the data here. We have the dot plot to see what they do with that. And of course, as I just said, pretty important if they mention the runoff and quantitative tightening, what they're going to be doing there. The other interesting thing is just looking at the, let's say something like the US dollar. We know that the US dollar, and again, we can maybe go back to, so I'm just going to go back to sort of chart here. If you look at the dollar index, we can see, otherwise the dollar index here. So we can see that the dollar index has been sold off a lot over the last, I'll just bring it up. Yeah. So you can see, we see that the dollar's down a lot. It's just kind of stabilized here around about the 103.30 kind of level. And the consensus has been, it's been a very strong consensus. We saw that from the Bank of America yesterday, the fund, what's it called, the fund managers survey, or asset managers, and everyone is piling into sort of European stocks and to a certain extent other rest of the world stocks, getting out of the US, and US exceptionalism is over. And there's been a lot of negativity, and that's become very much a consensus view. This rotation from the US to the rest of the world, especially Europe. And so the thing is, but mixed in with all of that, there is some sort of pessimism on the overall growth of the global economy, because China is doing some piecemeal stimulus. Europe, yes, it passed yesterday in Germany the infrastructure and spending bill and the defense spending, but this is a long-term plan, or at least a medium-term plan, and it's not as though those issues of malaise and competitiveness and sort of bureaucracy in Germany is suddenly going away, and Europe as well. And so the point is that I just wonder whether something, if the hard data in the US, it doesn't come in as confirming the recessionary sort of theory or thesis, could we start to get a bit of positivity for the US dollar? Because the point is that, at this point, there's been a lot of survey, there's been a lot of sentiment, and Europe's fabulous, and they passed this, defense spending bill and the huge stock rotation. We all get that, and maybe that's true. But the reality is that the hard data in the US is still relatively good. It's still relatively good. The unemployment rate is still low. We saw retail sales the other day. The core was relatively solid. We saw that on Monday. Inflation is a bit sticky, but it's not sort of hyperinflationary or anything. Of course, we understand that the US administration is trying to reduce sort of deficits and trying to reduce spending. But the reality is, how much can they actually do? I mean, the more I read about this, some of the cuts by Doge, they're very, they're quite symbolic in, the legal system. The judiciary is starting to push back, saying, hey, actually, you can't just sort of do this. So my point being that, maybe there won't be a growth slowdown, because maybe the deficit spending will not actually be reduced that much, and government spending will not actually be reduced that much. And maybe the US real economy actually remains relatively robust, maybe not booming, but maybe, relatively robust. And in that case, could there be a case that actually all of the optimism has been priced into Europe, not only about the defense spending and infrastructure spending in Germany and the negativity in the US, but also, for example, the peace dividend in the Ukraine conflict, Maybe is that, or is there time for a reality check? Has everything already been priced in? And we saw in the last 24 hours the famous phone call between Putin and Trump that, Putin is not necessarily easily giving in and saying, "Oh, yes, Trump, I love you. Let's do a truce immediately." And on the other hand, Zelensky of Ukraine is basically saying, "Hey, no Ukraine participation. We're not going to have a quick deal." My point being is that I'm not sure that there's going to be a very smooth, fast, quick, clean truce or sort of peace deal in Ukraine. And so therefore, I just wonder whether the euro stocks and the euro, like we're sort of at peak optimism and peak negativity for the US dollar. And if Trump, if Powell today signals, a little bit of hawkishness, especially, and we continue to get relatively solid data in the US. I just wonder if that sort of peak European optimism and peak American negativity and pessimism could just reverse itself tactically over the shorter term. Okay, guys. So I think that's about it. Just one other thing I just want to talk about a little bit, just in terms of the stocks and everything, is volatility. We can see that volatility here is the VIX just on a daily chart. We can see it's come down from a peak of essentially 30, just settling down and probably into fair value here around about 2021 handle or so. It's kind of just interesting here to see how vol has moved over the last sort of period. Basically, just to put it all in perspective. So if we look at the VIX, again, talking here Wednesday morning about 9:30 now, the spot price here is about 21.6. But you can see that the curve here is sort of a bit flat. And it's interesting if you look, let's say, a week ago compared to a week ago. So we see that, just look at that, the front, the spot here has come down a lot. And also, I want you to look at this shape here. Look at the shape here. The shape, which was in a pretty nasty sort of backwardation. These are the futures curves. You can see here the first future, the second future, the third future has flattened out a lot of it. So indicating less anxiety, so to speak. And if we look here, let's say the first future on VIX versus the third future, this is a 15-minute chart, so shorter term. But we can see that that really pumped up into a backwardated state with a premium or a spread of 3.6 on the 10th. So that's about 9 days ago. But ever since the 10th of March, we can see that that premium has flattened out. We're almost basically getting back to the more normal and the less volatile sort of flat. It's almost flat, you can see, between the first and the third month here, just like a 10-cent kind of premium there. So volatility is definitely is sort of low. And keeping that in mind, that's all things considered is not a bad thing for stocks. And it's kind of just interesting. I always just like to look at what the straddle is paying. So if we go to the ES, based on the March underlying future here, which is about to expire. But let's say we go to a 0DT here on the ES futures. You can see that if we put in, let's say we'll put in a straddle, we'll do it at, let's say this one here. And here. Right, so here we go. So we can see that the straddle there, let's say the 56.35, was essentially at the money. You're paying about, for the long call for today, about 26 points, almost 28 points for the long put. So in the totality there, you're paying for the straddle 54 points, which is about 200 ticks or so, 210 ticks. And if we actually look at what 55 or 54 points looks like on the chart, which I'll bring up here just to give a sense. I think it's about a % move or so. So the point is that the market is not, particularly poised for a massive move. So if we go here on the ES, and we just put in, just interesting to see. So that's what the straddle is looking like. The break-even point here, it's about up there to, it's interesting level, about 57.36 or so. So about 90 basis points. And if we look on the downside here, we can see about, what's it? The straddle, the downside, again, about a % or so down, about 200 ticks to, what's this level here? About 56.35. So basically the straddle there, it's looking about a % move, not expecting more than about a % move either way. So not a huge move. So again, market consensus, just to wrap it all up, is for sort of not too much change. What will be hawkish would be, if obviously be very hawkish if they move the dots and they take away a cut, because at that point, and let's just go back to the PDF here of the previous SEP. If I can find it. Yeah. So just to finish off here, what would be very hawkish, positive for the US dollar, horrible for the front end of the curve, would be if this 3.9 dot was revised revised up, of course. That would be very sort of hawkish. So that would essentially be taking away 25 basis points of projected cuts, which obviously everything would have to sort of massively realign. But again, don't expect that. I also don't expect there's any need for them particularly to be more dovish and make this, let's say, 3.6, because that would be sending a very strong signal that they essentially signaling that the current administration's policies will lead to a relatively soon will lead to sort of a growth slowdown, maybe even a mild recession. And I just don't think politically that's a message Powell wants to be talking about. As I say, just keep in mind the QT, any mention that they're stopping QT or they're going to give a relatively immediate sort of stop date, I think would be generally positive for risk assets, especially the equities, and long bonds would love that. So that's a possibility we need to look out for. Okay, guys, I think that's about it. I will leave it there for the FOMC preview. Have a great trading day, and we'll keep in touch, I suppose. Thank you.